Hello everyone, today we will talking about the pressure on accountants to prepare fraudulent or misleading activities. As we all know, every organization are at the risk of ethical fraudulent activity. But what the motivation for them to prepare fraud financial report? I will using fraud triangle to explain this the motivations. And Joey and Cassie will using two cases to explain, to show you how this motivation to make them to commit fraud report. Also, the accountability theory and stakeholder theory and agency theory will be mentioned in their cases. Finally, the recommendation will be given at the end. Firstly, as you can see a triangle on the screen with three factors. These three factors are the motivation for them to commit the fraud. The first one is pressure. This pressure could be personal wealth tied to financial result or other financial pressure to improve their earnings or balance sheet. The other one is opportunity. There are some warning signs to indicate the opportunity for accountants to commit fraud. It could be weak internal control or ineffective monetary management. The third one is rationalization. The rationalization usually be personal reason, and they think it acceptable, and they think everyone does it. Then my partner Cassie will present Jim Glenda cases.
Jim worked in AMA for nearly 8 years and has been vice president for 18 months. He earns $210,000 every year, and AMA gives him the sole authority. And he also gives himself access to senior executives' email accounts. He also creates an email account to transfer company money. His assets include a $5 million office building and 2 homes that cost more than $2 million. So how could he live like a millionaire with his salary only $210,000? Accountants is an important element. So let's look further of the case. With the pressure of the accountants is under influence. The accountants must be threatened that he will lose his job if he finds some disadvantage things to Jim. Next is the opportunity that AMA gives Jim the sole authority of the payment of the services and goods that consumed or utilized by the company. And the rationalization, the accountants may think that it's not my fault, it's not my business, I'm not the one who conducted fraud, and no one will find out it. 2 theories are related to this case. First one is the stakeholder theory. This one is related to the accountant. The accountant is not only responsible for the company, but also responsible to the people who are related to the company. And the next one is the agency theory. This theory is related to Jim. As a vice president, Jim is on behalf of the company AMA, and the AMA also delegates the authority of decision making. Next, our group member Joy will introduce you the case of Harry Scarf. Thank you.
Hi, I'm Joey, and I will present the case of Harry Scarf. A little bit of a background of the company. Harry Scarf is a discount retail chain that operates in Australia and went into a voluntary administration because of their accounting and financial report irregularities on their balance sheet. So there's an opportunity for them to commit fraud because majority of the audit committee comprises of senior management. And having the chairman owning 40% of their company's share give him rationalization to think that if the value of the company increases, share price increases, and therefore that he's able to make a profit from selling the shares of the company. And this gives them an undue influence for the accountants to prepare fraudulent and misleading report, and in this case that one of the accountant reported that he was directed by the CFO to falsify the accounts. And as a summary of this case, we can see that accountants have a really strong ethical responsibility in preparing the financial reports, and that's really relevant to the stakeholder theory in providing information that is reliable to the stakeholders. Nextly would be very close to stakeholder theory, which is the accountability theory on the second one there, which is we have to ensure that accountants and management really behave in the interest of the stakeholders. And that is maybe through monitoring management and also impose a really strong internal control. And in terms of the principle-based standards, we can see that the flexibility on the accounting standards have a really strong impact on the decision making, and that senior management might select treatments that not often reflect the value of the assets. And therefore, in this case, we can see the importance of corporate governance. And next, we would have Suwan, my teammate, to present recommendations for us.
The key point is to reduce the opportunity for accountants for fraud. Firstly, remove the flexibility from the accounting policy. For example, with a rule-based standard, under the influence in the judgment of accounting policy, choice can be avoided. Second, we'll develop an accounting process with strong internal control and good corporate governance practice. Third one, disclose the information, emphasize the ethical responsibility of organization to their stakeholder. That's all important. Then Joey will present a very brief conclusion.
As a summary of our presentation, we can see that in case 1, Jim's case, Vice President having a sole authority to control the accountants, and accountants in that case having pressure to prepare fraudulent reports and accepting false invoices. And also in case 2, we can see that the accountants in Harry Scarf having pressure to prepare misleading accounts. And we can see that it is really up to the accountants to behave in an ethical behavior to prepare a true and fair financial report. Thank you for listening to our presentation.